Greetings to everyone, and I hope we are all good. So maybe this might be my final video on taxation this semester, unless I receive um the taxation tutorial set 8. When I receive tutorial set 8 before the exams, I'll try and then solve it and then upload it. But if I don't, then this is going to be our last video on taxation for this semester. So this video is about some suggested solutions that will be for last year's or 2022, 2023, 2024's past question, right? So you know how I do it. After everything, I make sure that I try and then solve a past question and upload it before everything will be done. So here they are saying you should attempt all questions, 3 hours, round off all decimals to the nearest CD, right? We should always make sure we read the instructions. We round off all decimals to the nearest CD, and also mark will be awarded for sound, well reasoned and thought out argument. And also, you should show all workings and appropriate supporting schedules where relevant. All right. So question 1 is saying that always what I do is I first read the requirement. The requirement is saying that explain the difference between progressive tax system and a regressive tax system and state one example each of the tax system. Right. So here is what the listing is saying, the preamble. When introducing new taxes in a developing country like Ghana, the contribution of the new tax system to the system buoyancy when introducing new taxes in a developing economy like Ghana, the contribution of the new tax system to the tax buoyancy of the country is important. However, this will depend on whether the new tax instrument will be a progressive tax or regressive tax. So here they are telling us to explain the difference between progressive tax system and a regressive tax system. We know that progressive tax system is a tax system that the tax rate increases proportionately when the income also increases, right? So it have like direct relationship between the income and then the tax rate, not the tax liability, but the tax rate, right? So tax rate increases when income also increases. An example is the pay as you earn. And also the regressive tax system is a tax system where the proportion of tax increases whilst income also increases. What did I say? Sorry. The regressive tax system is a tax system where the proportionate of tax decreases when the income level increases. So this one has an opposite relationship between the income level and then the tax rate. An example here can be VAT or CST, Communication Service Tax. Right. So don't worry, I just woke up, that's why. B part of the question is saying we should state 4 transactions that require the use of a TCC, which is a tax clearance certificate. So B, in 2021, the Ghana Revenue Authority migrated fully to an online portal for the filing and payment of taxes. One process included in this migration was the obtaining of a tax clearance certificate, which plays an important role in tax compliance. And then they are saying we should state 4 transactions that require the use of tax clearance certificate. So a tax clearance certificate is a certificate or it's a document that is being issued by the GRA to confirm that a person has fulfilled his tax obligation for a specific period of time, right? So some of the transactions that require the use of TCC include an involvement in government tenders, also renewing business licenses, also obtaining visas and travel documents, Also, conducting certain financial and legal obligation, and also title registration and transaction, custom clearing and forwarding, also application for licenses under the Custom Act. And then I think I've said all. And also renewal of practicing licenses in professional bodies, right? So those are the transactions. These are some of the transactions that require the use of TCC. All right, so let's talk about the C. The requirement is that state for payment which a withholding tax does not apply. So we are now coming to talk about exemptions of withholding taxes, right? So a resident shall withhold the tax on payment of any dividend, interest, rent, royalties, natural resource, and payment with the source country. So now they say we should state for payment which a withholding tax does not apply. So a withholding tax does not apply to a premium that has been paid to a resident insurance company. Also, it does not apply to payment of sale of goods, which constitute trading stock of both the vendor and the purchaser. It does not also apply to the interest paid, dividend paid, or credited to a holder or a member on the investment in an approved trust scheme or mutual fund. Last but not the least, it does not apply to interest paid to a resident financial institution. All right. So now let's talk about this third one where it's saying that let's read the requirements. Compute their respective taxes payable for the 2022 year of assessment. So the information below relates to individuals who earn income in 2022 year of assessment. Resident individual. So these are resident. Mr. Agandi and Mr. Yoni are resident employees in Ghana. The chargeable income earned per annum by Mr. Agandi and Mr. Yoni amounted to 300,000 and 650,000 respectively. So we will calculate for that. And then we also have Miss Zidana and Miss Maleba. So these are non-resident individuals. Miss Zidana and Miss Maleba are non-resident financial residents, are non-resident individual. Miss Zidana and Miss Maleba has earned chargeable incomes to the tune of 300,000, 650,000 per annum respectively. So the clue here is that when anyone is an individual person, we normally use the graduated tax schedule. But if the person is a non-resident, we apply 25% tax rate on them flat. Right. So let me start with the resident person. I will have so Mr. Gandhi will come here. So Mr. Gandhi. For Mr. Gandhi is 300,000. So I'll put the chargeable income here. I'll put the tax rate here. Put tax rate. Terms of percentage. Tax liability. Terms of fairness. So now let's look at the graduated tax schedule as the last one. It's always given. It's at the last simplification. Get to this. The rate are 0, 5, 10, 17.5, 25, 30, and then 35. 0, 5, 10, 17.5, 25, 30, 35. And this is for the first, this is for the first 428, 4824, 1320, 1560, 36,000, 196,740, 359,556. So 4824, 1320, 1560, 3600, 196,740, 1. The next one is 359. But I'm not sure we'll get it. So let me just be giving space so that you'll be doing some. That's it. All right. So most of the Indian spaces. So just look at the graduated tax schedule, right? Here was the first one, the next one, and the likes. So here is going to be 0 because when we multiply the first 4,824% by 0%, we're going to get 0. Now, our balance here is going to be the amount that is going to be left is this minus this, right? Now, we take this and then pay 5% tax on it. So equal to 0.05 times this 66. Now, when we subtract, this is what's going to be left. Now, we pay this here, 10% of this is going to be 156. 10% of this is going to be 156. So the yellow ones are the graduated tax schedule. That's what we are going to apply. So each and every step, that's what we are going to apply the taxes on. Right. So now we subtract again and then see what's left. This is what is left, right? Now we apply this because this has the tax rate. So we apply 17.5 on this 36 now. So equal to 17.5 times this. 17.5. This what we get. And then subtract again. This what's left. Now we apply because this is still bigger than this. We apply the tax rate here. Now when we subtract, here's what is left. So the one that is left was will be sent to the next tax rate, right? If it wasn't, if there will still be an amount here that is bigger than this one, and that is bigger than this one. Sorry, that is bigger than 359,556. Then after doing it, we push the rest to the next one and then apply the 35% tax rate. So since this is the one that so we apply this 5,000, 59,556 on the tax rate. So you apply the tax rate on it. So equal to 0.3 times this. This is what we are getting. Yes. The total tax line. Then we should make sure that it is run to the nearest whole number. So to the nearest whole number. So let's do for Miss Yoni. I'm sure because of this, you'll be able to do for Miss Yoni. So you can pause the video and then try it yourself, right? So Mr. Yoni, sorry. All right. This chargeable income 650,000. Tax rate in terms of percentage, tax liability. So we can do up to here because this one was 300. So we can do the same thing and copy it up to here. We can copy everything. I've copied everything. So because I used the Excel to do it, so you see it has calculated the thing for me. automatically. Let me just add the other rate to 30, 35. So now go to this minus this. So you see, it's applying the this thing for me based on the 6,500. So it subtracted it because I used the Excel. That's why it has already subtracted this. Now this is what is left. And the next one here is 359. 359, 556, right? So I'm going to put that one there. Kindly like this video for me, okay? If you have not liked the video, kindly like the video for me, okay? Thank you very much. And we apply the percentage on it. Or you can choose to copy the same thing that was in the schedule, because when you check the schedule, you've done some calculations. So you can choose to copy up to where you think that this thing will reach, and the next one, so you calculate it yourself. Because you see here, the amounts are also here. All right, so now you can see that it's left with what? 50,000, all right? It's left with 50,000 here. And that 50,000 will be what? Sent to the next one. And the 50,000 that is left. Because it told us that exceeding the last one will attract 35%. So any amount that's exceeded, that's why we are using this one. So that is it here. Now, let me put everything here. Now get tax liability here. So tax liability is going to sum from around it. So this will be for Stayani. This will be for Mr. Gandhi. Right. So you can see that therefore the tax liability for Mr. Gandhi is 73,574, and also the tax liability for Mr. Yoni is 181,074 Ghana city, and you are done. Now let's move to the non-resident. Remember, the non-residents attract a tax rate of 25% straight, so chargeable income they also receive 300,000. So the first person is Miss Zidana, and then Miss Maleba. I'm putting Miss Maleba. So would this tax rate going to be 25%? 25. Let me just put the tax rate. Put the tax rate. 5. So let's calculate 25% of it. Equal to 0.25 times. So at so you say that therefore Miss Zidana or Miss Zidana's tax payable amount is 75,000, whilst Miss Malebe's tax liability is 75,000. Then the tax liability for Miss Maleba is what? 162,500. Then you are done. Let's move to the next question. Question 2. Mr. Hayo was employed. Mr. Hayo was employed by Golden Act Company on 1st June 2020 and on an annual basic salary of 40,000 by 400 to 56,000. He was paid a bonus of 24,000 in 2023. Now we are required to determine the tax on bonus and the total tax liability of Sir Hayo. Okay. Okay, so now we have to know what the basis period and the year of assessment, right? So question 2. So Mr. Hayo. Then basic salary computation. So we have to compute it first because we are coming to calculate the basic salary computation. Right. Now We have the year of assessment here. Okay, now let me put the basis period because I said this year of assessment. Then the basic salary. So um he was employed in 2020 first June. So from that time up to 2021, you still be receiving the same 40,000. So 2021, the basis period is going to be first 06, 1st June 2020 up to 31st May 2021. And his basic salary is going to be 40,000. Then 2022, I can just copy this. Then change it to 21. Then change it to 22. And this is going to be 4, 4, 1, 2, 3. Then 2023. And just change this to 4, 8,000. Even though say we are looking for up to 2023, right? But remember that this basis period still have some 2023 left because it started from 1st January to 31st May. We have still some minutes, so you have to compute for 2024 too. Let's copy the same thing. For 3. That one will be 5200. So our distance will be between here and here. So basic salary. So it will be between here and here because we have 5 months here in 2023 and then we'll have 7 months here in 2024. So it is going to be 5/7 here. Then I'm not talking about, I didn't ask you of dates. Adding will be this is yeah, this is 5/7. Ah, come on. I can try with you. So we have 5/7. So let me just complete it straight away. So it will be equal to this times 5. Wow. It's supposed to be 5/12. Sorry, I have 5 months, and then 5/12, and then here is also going 7/12 times this. So his actual basic salary is going to be this. All right. So this is the actual basic salary. Now we are told that he was paid a bonus, right? He was paid a bonus of um was paid a bonus of 24,000 in the year 2023. So we have to compute the tax on bonus and also the total tax liability. So remember that the law says that if you want to calculate the tax on bonus, then if you want to know the tax on bonus, the one that will attract a normal tax rate of 5% final is going to 15% of the basic salary, right? So let me see whether I can show it to you on the slide. Uh, you see bonus 15% of the annual basic salary, right? 15% of the annual basic salary. So this is 15% of it. And this will attract a tax rate of 5% final, right? So the tax liability would be equal to this times 0.05. So 3.378. That is the tax bonus on the final. Now let's look at the whenever we tax that 15%, the rest that will be left is supposed to be added to this, and then we use the graduated tax schedule to now do the rest. So now the excess of tax bonus, excess would be equal to the 24,000 minus this. And then this is the excess. So you are going to add the excess to it and then send it to the graduated tax schedule. So let's copy this here again. We reach there. Right. So here, the chargeable income is going to be equal to the normal basic salary plus the excess. That's going to be our chargeable income. That's what we are going to do. So that's it here. So that's what we are having here. And then when we subtract, that's what's left. And this is going to attract, because it is less than the this, which will not make it exceed. We are going to apply 25% because it is within this range, 25%, then equal to 0.25 times. So here's going to be his total tax liability. Right. So this is going to be his total tax liability when computing under the chargeable. Right. But the total tax, so tax, this will be the tax on bonus. The tax on bonus is the 378, and then the tax on income is going to be this. All right, so when we add the two, we're going to get our total tax. That's what the person asked us for. That's really for our total tax liability. All right, so we determine the total tax liability for. You can write, therefore, the total tax for say higher in 2023 year of assessment is that figure. 1 to 12,770. So now let's use this to the requirement is to determine the loan benefits applicable to each of the three employees for 2022 year of assessment. So the table below shows the incomes of three employees of Asari Limited in 2022 year of assessment. So we have the basic salary, 120, 160, and then 180. We have medical allowance, rent allowance, school allowance, and like. And their total cash emolument is 156, 208, 234,000. So beside the cash emolument stated above, so the employees receive loans from the employer, and then they are as follows. Adun received a loan of 24,000 at a rate of 5%, payable within 12 months. Seda also received a loan of 48,000 at a rate of 8%, payable within 24 months. Ayeyi also received a loan of 100,000 at a rate of 10% within 36 months. This loan is in addition to an outstanding loan of 50,000 with the same terms and conditions during the previous 12 months. Assume that the statutory rate is 30% per annum. And say we should determine the loan benefit applicable. So now this is mhm. So for Adam, because his loan is what within 12 months, which is within 1 year. And then when we check uh this 24,000, then his monthly, then his 3 months the 3 months of the annual basic salary, right? We are going to get something that is less than this. So uh, we are going to get something that is greater than this. So you can just take the 120,000 times 3/12. You see, you get around 30,000, which is greater than 24,000. So it doesn't make this attract a loan benefit tax. So we are going to write that Adom is not liable to be taxed on the loan benefit due to the fact that one, his loan repayment period does not exceed 12 months. And then two, he does not have any similar loan at that point in time during the last 5 years. And then three, his loan amount, which is 24,000, does not exceed his 3 month basic salary of what? 30,000. So the 3 months annual basic salary is going to be 120,000 times 3/12. And you are going to get 30,000, which is lesser than this. If the uh, if the 3 months was greater, was lesser than this, right? If it was lesser than the 24,000, then there will be a loan benefit in there. But as far as that 30,000 will be greater than this loan benefits or loan amount, then it will be what? Tax exempt. There will not be any loan benefit tax in there. Now let's move to Aseda. Aseda received a loan of 48,000 at a rate of 8% payable within 12 months. First of all, the loan is what? More than 2 years. So a loan benefit is here. I mean, as far as I see this, one of the criteria, I'm gone. And then when we take 160,000 times 4 over times 3/12, we are going to get something that is lesser than 48,000. So the 48,000 is going to be greater than the 3 months of it. So it is going to attract a loan benefit here. So you state that Aseda would be taxed on the loan benefits. The reason is because her loan repayment exceed 12 months. That's the first one. And then secondly, her loan amount 48,000 exceed her 3 month basic salary of 40,000, which is the 40,000. You're going to get it from calculating 160,000 times 3/12. Right. So I said that I'm just skipping Adam. So you write that bro there for Adam. And then let's come to Aseda. So for Aseda, we are going to tax them. So we have two ways of doing this, right? What we are going to do is you can first subtract the rate, loan benefits. The loan benefit is going to be 0.3, right? The rate, let me put the rate here. The rate is going to be into bracket, so equals into bracket 0.3 minus his own is 0.08, right? So we subtract the statutory rate from the loan listing rate. So we will get This is what we are going to get for the rate. And then his loan amount is 48,000. So now it is going to be equal to this times this. This is loan benefit, right? But the law is saying that when there is a loan benefit, we multiply it, or the 25% of it is going to be taxed. It's going to be the tax liability. So tax liability or tax on loan benefits is going to be equal to 0.25 times this. So this will be the tax on his loan benefit, or his or her loan benefits. Right, now let's move to IAE. So for IAE's own also, he received a loan of what? 10,000, 100,000, sorry. And it is payable within 36 months, so which is clearly more than that. Now, remember that IAE will be taxed, because will be liable to tax on the loan benefit because his loan repayment won't exceed 36 months. Also, the aggregate of the current loan, which is the 100,000, plus a similar loan outstanding during the previous 12 months, is 150,000. So when you add this and then this, you are going to get to 150,000 with the same terms, right? So, and also, when you add it, it will also exceed his basic salary. His 3-month basic. So 150,000 will be greater than the 3 months, which will be 180,000 times 3/12, right? So, which means that we are going to tax this loan. So there's a loan benefit here. So this rate is going to be equal to 0.3 times 10. Hey, 0.3 minus the 10%. 0. Then now his loan amount is going to 150 because he had an outstanding this thing already. So the loan benefit is going to be equal to 0.2 times this. Okay. Right. So this is going to be his loan benefits. Now, let's find the tax on loan benefits. It's going to be 0.25 times this is going to be a tax on loan benefits. Right. So you just have to read the law and then the act, sorry, then get all this. Now we are done with question two. Let's move to question three. So the following information is available to you as a tax consultant as a requirement. Compute taxes from the above information and indicate whether the tax is final or not final. So these are the ones that we have: dividend paid to residents, dividend paid to non-residents, payment of goods to residents, payment of goods to non-residents, rent and residential property, rent, residential property, rent, commercial property, natural resource payments, management and technical service fees for non-resident, and also interest paid to resident financial institution, royalty paid to non-residents. So these are the figures or the amounts in here. These are the amount. So this goes for 10 marks. So what we are going to do is we are going to create a table. Remarks. All right, so description, let's start with the first one. The first one is what? Dividend paid to resident person. The amount is 100,000. And for this one, the withholding tax rate is 0.08. You have to chew it, 0.08. And then the tax that will be withheld will be equal to this times this. And then it's final. For dividend, it is final whether resident or non-resident. It's final. The next one is dividend paid to a non-resident person. This amount was 200,000. The rate is still the same, 0.08. And then the tax held will be this times this. And it's also final. And the next one will be payment of goods. Remember when I was solving a tutorial, I told you that anytime you see anything concerning non-residents, yeah, it is final. If you can't do anything for non-residents, then you know, final. Let me see whether I can put this first. Payment of goods to a non-resident person, to a resident person, 300. And then for this one, the law states that if the good is above 2,000, then it attracts a tax rate of 3%. Let me just put it. It attracts a tax rate of 3%. But if the person was, if what was here was less than 2,000, then it will be tax exempt, right? So 3%, and then the tax rate held will be equal to and this will be not final. Right, so I think I just need to be putting the distance and the rate. So payment of goods to a non-resident person is 400,000. Then it is at the rate of 20%. I'll come back there. Then this is final. Non-resident is final. Then the next one is resident, rent, resident, residential property. The amount here is 150,000, and its tax rate is 8%. Then rent, commercial property. The amount here is 300,000, and its rate is 15%. Then natural resource payment. The amount is 1 million, and its tax rate is 0.115%. Then management and technical service fees, non non-resident. Then it's 400,000. And then its rate is 10%. Then we have interest paid to a resident financial institution. The amount is 20 million. And interest paid to resident financial institution is tax exempt. So the rate is 0. tax withheld will automatically be 0. Then royalty paid to non-residents. $400,000. 400,000. And it's 15%. So payment of goods to rent property. This one is final. This rent. This one is also final. And the natural resource payment is final. This one is also final. And this is tax exempt. The payment to interest paid to resident financial institution, tax exempt. Then this last one is also final. The royalty paid to non-financial. Every non-financial I told you is final. So let me just use this thing to calculate the rates. So these are the rates respectively. These are the tax withheld. Okay. All right. I think you're done with that one. Let's go to the next one. This God's Food Limited commenced business on 1st March, preparing account to December each year. The following assets were acquired for the use in the business. So we have, okay, this was even treated in our tutorial set, I think set 4 or so. So the same thing is here, right? So industrial building 15,000 was acquired at the 15th October 2019. But I said that when we are dealing with capital allowance, the date of acquisition is not important. So what's important is the time that the business commenced, right? So that's what we are going to take into consideration. And also what you need to take into consideration here is also this Toyota saloon car, this 180,000. Since it's a saloon car or it's a car that can carry a weight that is no more than half a ton, or it cannot take 13 passengers, we strike the value to 75,000. So let's do this right now. So let's create a table. The So first we'll have year of assessment. Then we will have the pools. So pool one, which will be 40%. Pool two, which will be 30%. Pool three, which will be 20%. Pool four, which will be 10%. And because there's no pool five in here, which is intangible, so we leave it there. And this will be our total. So Ghana cedi, Ghana cedi, right. So in the year 2020, where our basis period was 1st March 2020 to 31st December 2020, right? That's when we commence business. So anything that was there before and during that year is supposed to be placed in here. So pool four, we can only so far identify only computers as pool four, sorry, pool one. We only identify only computers here. So it's going to be 80,000. Then pool two here is plant and machinery, a motor van, and also Toyota saloon car. Remember that on 31st October 2022, the Toyota saloon car was involved in an accident. So we have to keep this in mind that we are going to do something in 2022. And then also there were some purchases also here in 2022. So we have to keep that one in mind. So pool two here is going to be equal to the plant and machinery 1.6 million plus 220 plus the saloon car will be strike down to 75,000. So you have this. Then for pool three, you have only office equipment. And then pool four, we have industrial building, which is 2.5 million. Right. So I think I can make this make sense. And then, so when we check, we can see that this is going to be 306 days. So our capital allowance is going to be this one, for example, 0.4 times 80,000 times 306 over 365, because There's only 365 days, 306 days. This is what we get for a capital allowance. For this one will also be equal to 0.3 times 189,500 times 306 all over 365. All right. So this next one will also be 0.2 times 138,000 times 306 over 365. This one is going to 0.1 times 2.5 million times 306 over 365. Now our total capital allowance here will be equal to total capital for the year to be changed. Now written down value 0. So now in the year 2021, where are these things going to be? 1st January 2021 to 31st December 2021. We are going to have 365 days, right? So we don't need to now apportion anything. So our capital allowance is going to be 0.4 times this written down value here, 0.3 is written down value here, 0.2 times This is going to be 0.1 times this. Normally, pool 4 is calculated on the cost. You don't calculate it on the rating number. Only pool 4 on quantity to be on the cost here. You get it. So right, so written down value let's spread it. All right, so in the year 2022, where we will start from first to to 31st, we are still going to have what 365 days. Right. Now, because there were some additions and subtractions in here, we are going to do with that one page before we calculate our capital loss. So let's deal with the additions or purchases. So the purchase computers and accessories, which is 105,000, which is in pool 1, right? That's why it's under pool 1. Then purchase office and equipment, which is pool 3. We give you a dash. Then pool 1, 78,000 into 0. Then there was some subtractions or disposal. The disposal, or it was the Toyota Saloon car that had the accident, and it is in pool 2. And this is what I don't understand about the tax man. You the thing when it was 180,000, you say you won't apply 180,000 on it. But when the person was compensated 120,000, that's what we are going to write here. So 120,000. There was nothing here, nothing here, and nothing here. The disposal will be minus. Right, so now, after doing all this adjustment, we apply our rates on it. Now we come and then calculate our capital allowance. 0.3 0.4 times I wanted to finish this in 1 hour. And I mean, then remember that this will still be calculated at cost. So we got 0.1 times cost. And down value. So you see what we're only looking for is the capital allowances, right? We're only looking for the capital allowance. That's why I'm only adding the capital allowances. So this is it up to this point. And then now they told us to compute the capital allowance. We are done with that, and then we should compute the accessible income for the company for the relevant years. So accessible income for year of assessment. Right. Now this is the net profit. Net profit is here. Then we less capital allowance. Let's go and take the capital allowance. When we check, we'll see that we'll be making a loss. So loss to be carried forward. This is the loss to be carried forward. Now, taxable income for 2021 year of assessment. This one by we are going to less previous year loss. Less capital allowance. Going to be this minus this minus this. And let's go to 2022 IOA. Oh, I didn't bring the net. Net profit for that year is 268. Then less capital. So we are done with question three. Therefore, question three. When you write some small English, therefore, the allowable accessible income for the year 2020 year of assessment is senior, right? We will not have anything. So the loss to carry forward is this one. Then the next year's accessible income is 644,079. And then 2022's one is 2 million It's 79,590. Then we are good to go. So let's move to question 4. For A is asking that calculate the tax payable by Musosho Limited for 2022 year of assessment. Okay, now, for A is in state what constitutes finance costs from derivatives. Explain the tax treatment of finance costs from derivatives under such as KK Company Limited. That is neither a mining nor petroleum company. And compute and explain the allowable financial cost for derivatives. And then assume that all facts are the same, except that financial gain from derivative is 60,000 and financial cost from derivative is 30,000. Compute and explain the allowable financial cost from derivative. All right, so let's do that one first. So for A, what constitutes finance cost includes the writings on, I don't want to type, includes financial instruments price. It also includes commodity prices. It also includes foreign exchange rate index prices and also credit rating or credit index. So that is it for that one. Then II, explain the tax treatment of financial costs from derivatives under a company such as KK Limited. So the treatment of finance costs is that it should not exceed the finance gain by that person that has been included in the person's income plus 50% of the adjusted chargeable income for a year of assessment. So any excess can be carried forward for the next 5 years and are used in the order they are incurred, right? So we'll compute it very soon and you understand why it is this way. We've done this in our tutorial set already. So if you've been following all the tutorial sets, so these questions, none of them should comment your life. And here they say we should compute and explain the allowable finance cost. We've done B. Then we are on C. So with C, we are going to do the adjusted chargeable income. So the Ghana cedi is already here. So we start with our profits before tax. Then what we are going to do is we add back finance cost and then less finance gain because it was added back. So we add finance cost and less financial gain. So adjusted chargeable income would be equal to this plus we add finance cost minus finance gain. Right. All right. So now, according to the law, the allowable finance cost, allowable finance cost would be the finance gain, financial gain. Financial gain 42,000. Then we add 50% of adjusted chargeable income. Yes, adjusted. So our total allowable would be equal to, all right. So this is it here. Now, this is our allowable finance cost. And this was the actual finance cost. Right? So the allowable finance cost would be this. That's the buffer that you are going to write. Allowable finance cost will be this. And then the excess, financial cost and CASA is this. Right. So let's see excess. Excess will be equal to this minus this. Right. So this excess being here will be carried, can be carried forward for the next 5 years. Right. And it is carried in the order of which they incurred. So we will say that the allowable finance cost is the finance gain plus 50% of the adjusted chargeable income. Then any excess, right, will be can be carried forward for the next 5 years. So when we subtract the allowable from the actual finance cost, we get excess if any. That is in the case where the finance cost is greater than the allowable. But if in case the finance cost is lower than the allowable, then what we are going to do is we are going to take the finance cost like that and then we subtract it that year for that year. So let's go to IV. IV is saying that everything is the same, but they've changed the finance cost and finance. So let me copy this. So they said they've changed the finance cost to be 30,000 and finance gain to be 60,000, 60,000. All right. So then this is going to make our allowable finance cost. All right, so finance is 60,000. So now let's look at the allowable finance cost here. The allowable finance cost here is what? 111,000. Then the finance cost is 30,000. So in this case, we are going to take the 30,000 in, like the 30,000 is the one that is allowable and not the allowable this one, right? So because the above computed is greater than, because what we've computed is greater than the actual finance cost, we are going to use the, or we are going to allow only the actual finance cost or financial cost for that particular year of assessment. So that's it, simple and then straightforward. Now let's go to B. Social Limited declared a net profit of 500,000 for the 2022. The expenses for repairs and improvement for that year, for the year, was 60,000, and the written down value of pool 2 was 600,000. Now they are saying we should calculate the tax payable by Social Limited. Start with the net profit. $500,000. Then expenses for repairs and improvements, we add back repairs and improvement expenses. This is how it is going to look like. Now, with less allowable repairs, so this is going to be, remember the allowable, this is the 5% of the written down value. So 0.5 times the written down value. 0.05, sorry. It is the allowable one. So we less it. That taxable income. We apply our tax 25%. So therefore, the tax payable by Moshoso in the 2022 year of assessment is 132500. And let's move to C. Chicago, Ghana is a branch of Chicago International declared a loss of 500,000 in 2020 year of assessment. In its return, which was confirmed by the Commissioner General. Chicago has just submitted its returns for 2022 year of assessment, and below are extracts from the returns. Net profit as per accounts is this. The following were charged: depreciation, loss from 2016. Remember, losses are only carried to the next 5 years, but in 2022, they charged that loss, so we have to take it out. And then agreed capital allowance with GRA, and then this is the corporate tax. So the attendants to determine the tax payable on profits by Chicago, Ghana, in the year of assessment. So 2022 year of assessment, so Chicago, Ghana. We start with the next profit, 20 million. We add back depreciation, then we add back loss from 2016. Then, sorry, I'm going to now release capital allowance. Yes, there was a loss declared in 2020, which was 500,000. But because they didn't give us any profits for that particular year, like in the next year, for example, if they had given us a profit in 2021, then we could have subtracted and get whether there is still any loss to be carried forward or not. But since they are silent on giving us any profit for the next year, because this loss was declared for 2020, right? They didn't tell us any profit or loss for the next year, 2021. So we also become silent on this amount, right? So we don't treat it. If this was to be in 2021, then we would have also less it. But since it is silent and then it's also on 2020, we leave it like that. So, also, yes. So this would be accessible income. Then apply our tax, 25%. So this will be our tax here, the appropriate tax. Net income after tax. Where is it? Right. But because this is a branch here in Ghana, this net income is subjected to another tax of 8%. You have branch tax is going to be 8%. It's going to be equal to 0.08 times the net income. So any firm that is outside and doing business here will be subjected to something like a double tax. The normal corporate tax and then also a branch tax on the net income. So this is going to let the total tax payable equal to this plus this. This is the total tax payable. Therefore, the total tax payable by Chicago is 6,211,275 Ghana cedis. You are done. And let's go to question 5 in 2 hours. Okay. If in exams for 2 hours, you are on question number 5. It's okay. I have 1 hour to finish one. So the requirement is to compute the tax payable by each company. So ABG Limited is a free zone enterprise established in 2011. Remember, the free zone enterprise, they receive, they are tax exempt for the first 10 years. And after that, they are charged 15% tax rate. So this one, for example, here will be what? Subjected to what? 15% tax rate, even though he is in Accra or Tema or whatsoever. So the company is part of Akafina group of companies with subsidiaries located in Accra, Kumasi, Ayan, Furi, Tema, Cape Coast, and Godi. The following information is relevant to the operations of Akamfina Group companies. So these are the companies, these are the profits that they made, and then the location, and then the activity they do. Right. Now, um, computed tax payable for each company. So question 5, that right question 4. Yeah. 5A. Let me just create a table. Okay, so the table is already here. The companies, location, activity, Ghana city, rate, tax rate, and then tax payout. For me, I suggest that since they left everything in millions. You to leave them in millions like that. Okay, so the first company is ABG Limited. Its location is in Accra. Its activity is manufacturing. The profit is 28. And then I told you it's a free zone company, right? So free zone attract and was established in 2011. And as at 2022, there, it passed their 10 years. So 15%. So 0.15 times 28 is 4. The next one is Adorso Limited, located in Tema, manufacturing. Its profit is 13. And then the tax rate for that matter is 25 because it's in Tema and not a free zone. So this thing is going to be equal to 0.25 times next one is, let me just enter the breakfast. Okay. And they say it was established since 2015. So this one is in Marseille. This one is in Body. It is in Ayan Furi. And it's in Accra. So this is about tax planning. This one. That is doing tree crop farming. So profit is 14, 22, okay, 14, 14, 20. Now, because this one, for example, is located in Kumasi. It's in the regional capital, so it will be attracting 18.75. These are the rates, so you can check it out at the tax planning and administration listing. Then this is located in outside a regional capital and also outside Accra, so it will attract 12.5%. And then this is also Ayan Furi. 12.5%. And then this is in Accra. So Accra or Temacha, 25%. And then tree cropping after their concession rate, this thing attracts a tax rate of I think is it 25% or so. But it was established in 2025, and I think their concession is 10 years, and this is just 2022, and so they are still in the free zone. Under normal circumstances, the current rate here is 5%, but at the time they said this question it was 1%. We use that 1%. So most often you check the year, this 2022 it was 1%, but 2023 coming down, it is 5%. So I'm forward to forward to forward to So this will be their tax payable. So tax payable by each company, 4.2 million, um, 6.25 million, 2.625 million, 2.750, 2.75 million, 4.125 million, 3.5 million, then 0.2 million. Now the tax payable by each of them. Right. Now let's look at B. This is in that the cost of iron rods supplied by Akinto Steel Works Limited to Ubuntu Construction Limited in 2023 is worth 300,000, inclusive of national health insurance levy, uh, get fund, and then COVID health levy and value added tax. So they are telling us to I calculate the national health insurance levy, get fund, COVID-19 health levy, and then value added tax. So before we can calculate the get fund and those kind of stuff, because they have been included, we have to first do the VAT. So let's do determination of VAT. And then let me see. Right, so I'm just praying they don't change the year. So if it is before 2023, I think the VAT will be 12.5, right? But um but if it is around 2023, then it is 15. But because they said in the sake of exam we should use 12.5, I'm going to use 12.5 to compute this. So it is going to be 12.5 over 115, 1125 times the 300, right? So equals 12.5 over 112.5 times 300. That's what we are getting for. But now we determine VAT exclusive amount. So this is going to be 300,000 minus this. Okay. So this is going to be the VAT exclusive amount because it's going to be our VAT exclusive amount. Now let's now calculate for the other ones. Let's bring our VAT here. And then NHIL. NHIL is what? 2.5%. Right, to be because it has been added already. So we are bringing it down 2.5 over 106. The reason why it is over 106, we know, is because 266, is because the NHIL, the get fund, and then the corporate levy are charged together and they are inclusive together. That's why. So when you add the NHIL, which is 2.5%, get fund is also 2.5%, corporate is 1%, to be 6%. So that's why you're having this here. Equal to get fund Get anything in COVID. Now we add all of them. And use it for what we get for. So that's and they tell us I we should calculate the VAT then. So now this is the VAT. Now this is the VAT, this is the NHIO, this is the get fund, this is the COVID. Now I said we should calculate, determine the withholding tax. So I withholding tax. Remember, withholding tax is normally calculated after taking the VAT and everything out, right? So you have to bring the contract sum. Then we less VAT plus levies. So oh, this minus this. That's the amount explicit. Now we calculate our withholding tax. It's 3%. When we supply any good more than 2,000, it is 3%. So equal to 7,547. Our withholding tax is 7,547. Now, III is saying that what will be our tax payable at assuming that they defer the distance for 11 days. So when they defer or they don't pay it for 7 days, their penalty will be 500 will be equal to 500 plus into brackets 10 times 11 days. In total, the penalty is going to be 610. Right. Right, let's compute for C. C. Lolo Group of companies is noted for employing fresh graduates in 2022. Now, um, Lolo Group company is noted for employing fresh graduates in 2022 year of assessment. The company paid a sum of 100,000 as salaries to fresh graduates, assuming the total workforce of the company is 100, and which three were fresh graduates. How much additional and total deduction would be entitled by Lulu company? So this is where you have to take that exemption inside. So remember, in our sessions, we said that when it is 0 to 1%, they get an additional deduction of 10%, right? And when it is between 1 and 5%, they get an additional deduction of 30%. And when it is above 5%, they get an additional deduction of 50% of the basic salaries, right? And here, when we compute 3 divided by 100 times 100, is going to give us 3%. It's going to give us 3%, right? So then it is qualified for a 30% additional deduction. So now we are going to bring the salary so we are going to bring the salary 100,000, and then our deduction is going to be 3%, 30%. So 0. Equal to 0.3 times this. So the allowable deduction is going to be 30,000. How much additional and allowable? So the total allowable deduction and the additional is this one, 30,000. So I think this comes to the end of this question. Hope we are all prepared. Me, I'm not that prepared for the exams. I'm not prepared. Telling you the truth. So Charlie, kindly like this video if you find it helpful, and also subscribe to my channel for more updates. Thank you very much for your time. See you some other time. This video is super long, but I beg, if I'm to break it into two, maybe I might even forget. So I try my possible to do it one. So that's all. All right. Have a good one. Bye.